In this week's update, the art of timing the market, gold steadies, and Bitcoin looking pretty precarious. My name is Garry Davis, and as always, this is general advice in this video, and please remember to like and subscribe to the video. Another really fascinating week, I guess, as pretty much all weeks are. This is a time like no other in history and in the market, and you just don't want to fall asleep for a minute. It's so absorbing. So the perspective I want to discuss today is really about staying on top of this rotation that's going on. We're getting a lot of short-term rotations, and it is tripping up a lot of traders and some investors as well. So this is I think a topic that's fairly timely. So there is a shift. We saw obviously a massive shift away from technology starting in the early part of this year. That is partially reversed, and we're now getting a series of quite short-term rotations. But at a bigger level, we have got more sectors that are performing strongly than what we saw in 2020. 2020 was so much about technology and consumer discretionary. They were the main leaders. But now we've got a more broadly based set of leaders, and some of those are doing short-term rotations, which creates the possibility that those trends are over. But it's tricky, but I think it's good that we've got a more broadly based rally. Now, the market belief isn't necessarily correct, but the market belief at the moment and what's driving it is that inflation is not an issue. Earnings are unquestionably strong, and we've got earnings season starting in a couple of weeks, and the economy's on a very solid footing. So that's the market belief, and that is what is driving the performance of the indices. So if we look in the US at what is outperforming now, it's XLK, technology, XLE, which is energy, XLY, which is consumer discretionary, and XLF, which is the financials. And I'll throw in a fifth one as well, which looks very much poised for a breakout, and that's healthcare, XLV. So that's certainly a sector worth giving some consideration to. All right, now coming down to a sharper focus on what we can do for those that maybe have got more of a trading approach, more of a shorter term, not necessarily really short term. We're not talking day trading here, but we're talking about shorter term focus, as in several months. Because with the market flicking backwards and forwards, if you want to make real progress, you've really just got to take advantage of some of these trading opportunities. And trading is about odds. It's about probabilities. There are no absolutes. All we've got in our favour is odds and probabilities. But in my more than 3 decades of experience, very, very few people use those odds and probabilities to advantage. There are some very clear-cut patterns for those that trouble themselves to look, and I'm sure that most people have read lots of so-called expert commentators that say, well, you can't time the market. It's time in the market that's important. Well, my response to that is that, those people just haven't applied themselves diligently enough to understand and recognise market patterns and what you can do with it. So there's no question in my mind that there are very, very clear-cut patterns, and I'll just give you a couple of for instances. In the US, there is a huge skew to stocks that rise in the 4 weeks or so before earnings season. Now, that's observable at the index level, and you can go back decades and decades. And the difference in performance is quite extreme. It's 3 to 4 times in the week or the 4 weeks leading into earnings season. The overall average performance is something like 3 to 4 times the rest of the year. It is very, very substantial. And that sort of makes sense because Wall Street knows what's going on with companies. They've got analysts out there talking to companies all the time. They know who's going to produce a good earnings report. And so Wall Street is buying before the event, as you would expect them to do. It would be stupid to expect them not to. So stock prices often rise into earnings season in the 3 to 4 weeks before a company reports, and then might go down, might partially retrace after earnings, or may in fact go sideways. And I'm sure people have also heard the term, buy the rumour, sell the fact. And, that is what's really driving that observable pattern. And it's very tradable because some of these rises are between 20 and 50% leading into earnings season. So, why wouldn't you try and trade that and take advantage of the opportunity? So that's at the index level, a huge skew. Then if you look at XLK and XLY, technology and consumer discretionary, the outperformance is even starker. Those sectors have an even more pronounced bias to the 4 weeks leading into the earnings. And then if we come down one level more and we look at individual stocks, and you can go through any number of stocks you want to, particularly it's more reliably observable if you look at some of the majors, because they're always generally cranking out pretty good earnings. And at an individual stock level, as you would expect, the best stocks, their outperformance is even more marked. So as you come down from the S&P to individual sectors down to individual stocks, the amount of advantage you can get by trading the 4 weeks leading into earnings season or leading into individual stock earnings is very, very substantial. And it's worthwhile taking the trouble to understand it and to get yourself organised around that. And we're seeing some of those runs already. And we'll look at a couple of those stocks. So what to expect? Look, we're seeing a series of, short-term and probably quite small rolling retracements to trend. We're not seeing large pullbacks anywhere, and certainly not at the S&P level or the NASDAQ level. We are seeing it a little bit more at the sector level, but really they're pretty short, they're pretty small, and all that's happening is we're getting a retracement back to trend. So that's the overall perspective on what is going on in the market. And I'll take a look at a couple of stocks now, just to reinforce that point. First of all, I'll start with Bitcoin, just to get that one out of the way so I don't forget. This is the Bitcoin chart on a daily chart. You can see we had a tiny little break of support on Tuesday, Tuesday, and there was a lot of press around that, and we got a big reversal, and then we got nice follow through buying on Wednesday and Thursday. But all that came unstuck again on Friday, which was quite an emphatic candle to the downside. And these observations are made purely, this is not anything to do with Bitcoin, this is purely an observation about technical patterns. The more a support level is tested, and we've obviously got a critical support level here at 30,000, the more a support level is tested in anything, the more likely it is to break down. And the converse is true to the upside. So that's the pattern. So at the moment, you would have to say, on what we can see at the moment, the probability is that Bitcoin is going to break down from 30,000. And if that is the case, I think, all hell's going to break loose and we're going to see a very substantial move to the downside. So that is just an observation of the chart. We're at the bottom of a trading range. The moving averages are well and truly rolled over. That's the positioning on Bitcoin at the moment. Now let's turn to the specific indices. So this is XLK. This is technology. Technology was probably at its worst in the early part of May, and since then we've basically gone up, and technology as a whole has broken out. Now that is partly because of the performance of stocks like Amazon and Google and Facebook, and those sort of stocks have certainly propelled that. a lot of individual technology stocks have not broken out, but are certainly looking a lot better in the last few weeks. So that's XLK, basically new all-time highs and unquestionably in an uptrend. There's XLY, consumer discretionary. Hasn't quite broken out above the April highs, but you can see in the last week, consumer discretionary has done very well. And if we go back, just one other thing I want to point out here is this is XLK versus the S&P 500. And I've covered this topic of relative strength many, many times. It's very important because it's very important to US fund managers, and they do actually respond to it. They have to position themselves to be overweight in the sectors that are outperforming the S&P because that's how they keep their job. So you can see the outperformance of XLK relative to the S&P. Now the XLY has not quite done it except in the last few days. We're just starting to lift. But I think XLK is one that is probably going to break out in the near future. Now, energy has been incredibly strong, and I'll talk about energy later. The crude oil price continues to rise, and XLE is still trending very well. And here's one of these short-term rotations that I've talked about. So just really a couple of days just to clear the froth off the top, bring it back to the 50-day moving average. And this is the finance sector. Now, it sold off a bit more. The rotation was a little bit more when the yield went down from 1.7 something down to 1.4. But the yield did, and XLF was already moving up prior to this, and the yield did spike up a little bit on Friday. We'll come back to that. So that's XLF. The one to watch, this is XLV, healthcare. Hasn't broken out yet, but gee, it's looking like it. You know, we've got a rising triangle, and it's looking very, very positive. And you can see the orientation of the 20-day, the green line, the 50-day, the blue line, and the 200-day, and the prices above all of them. You know, that's just a classic orientation. And again, this is not a guarantee of anything, but the probability, the odds favour a breakout when you've got that sort of orientation. Now, I'll just show you a couple of other things that I'm talking about with respect to this seasonality and the ability to be able to time your entries and exits into the market. So this is Amazon. I could show you 100 charts that look like this. So Amazon has been in a big consolidation since early September last year. We're right up the top up until a couple of days ago. We're getting a mild pullback from a triple top, which is pretty normal, but the odds favour a breakout, and the reason why is because they report earnings on the July 29. So therefore, based on decades of history, it is likely, again not a guarantee, but it is likely that we will see the price firm from now to the 29th of July, because Wall Street, you know, will understand what Amazon earnings are likely to look like and are probably going to be buying the stock in advance. So that's where the odds lie. Now, and the other point about this is if Amazon does manage to break out in the next 3 or 4 weeks, then after such a lengthy consolidation, the breakout is likely to happen with a fair amount of momentum. It's like a coiled spring. The momentum it's being, you know, twisted tighter and tighter. And a breakout after the best part of 9-10 months is going to be met with a heck of a lot of buying. Now let's look at another one of my favourite stocks. This is Carvana. This is one of these stocks that's got extremely high, go back to 2019. It was expensive by any stretch of the imagination, but the revenue growth rates are so high that it's rapidly going to have moved from being very expensive in 2019 to just downright cheap in 2022 at the current price. Now, we saw a consolidation. It didn't really break down during all of this stock outperformed a lot of technology stocks by holding in this range during the period from January to just recently. Formed a low in the middle of May, and then since then it's it's just gone up. And again, we're at a double top. We're getting a little consolidation the last couple of days. So what can we say about the odds around Carvana? Well, firstly, the fundamentals are great. The growth in revenues is just extreme and looks set to continue and possibly even accelerate. The environment of low interest rates, high stimulus, considerable consumer pent-up demand and spending power is very supportive. The next level, we're looking at XLK and XLY, which is what this stock straddles. So this is disrupting the automotive selling and buying industry. So it straddles those two sectors. So we're seeing a rotation of money back into XLK and XLY. The next thing is that the price has risen strongly in the last 4 weeks. Now, I can't remember when they report, but I don't think it's until early August. So we've still got more than 5 weeks to earnings, yet the share price has already risen. So again, the odds favour the next 4 weeks. It's not going to continue and advance every day, but over the next 4 weeks, the odds would favour the price moving higher, which then obviously means a breakout. We're consolidating at an all-time high and a double top, which is normal. You really want to see that. And again, as with Amazon, the breakouts from lengthy periods, and in this case, it's been consolidating for 6 months, are quite often explosive, particularly in stocks like this. Now, there's many, many more of these kinds of stocks that we can use to our advantage. So coming back now to the American market, the S&P gained 2.7 for the week, so that was a pretty good week. New all-time highs for the S&P, new all-time highs for the NASDAQ as well. The short-term action is being driven a lot by the rhetoric of the Fed. I get the feeling that some of them are being sent out as messenger boys to just keep the market a little bit calm. Every now and again they talk about the dot plot and anything else that might just stop the market from getting ahead of itself. But equally, the Fed does not want the market disrupted either. So they're just trying to manage expectations with what they say in public. Now, it would appear that there's an infrastructure package is likely with no new taxes, and that certainly helped the market as well, because obviously new taxes is something that the market's a little bit apprehensive about. And finally, if you look at the big picture, particularly relative to the very low interest rates, stocks really are not overvalued. Now, I know that some commentators that want to use the Cape Shiller Index or whatever can make a case for the fact that stock valuations are at historic highs, but I just don't agree with that analysis. Personal view, but I don't agree with it because they're looking at it in absolute terms. They're looking at it compared to periods when interest rates were extremely high, and now interest rates are extremely low, and there is no question that stocks should be valued more highly in a low interest rate environment. So to discuss valuations in an environment, in isolation of interest rates is, to me, is just not valid. The US dollar eased back a bit. We had a real surge the week before, but we eased back to 91.8. The 10-year yield did spike up a little on Friday. I'm not quite sure what drove that. Could have been a Fed comment or could have been a piece of economic data. It doesn't really matter. But the VIX, I guess, says it all. It's just holding steady in this range between 15 and 16. So let's take a look at a couple of quick charts. We'll look at the S&P. So there's the very big picture. There's a monthly chart, and you can see we're in this secular bull market that started in 2013. We've had one cyclical bear market, which lasted a month. That was thanks to COVID. And we'll probably get another one or two before this is played out. But the odds are this secular bull market extends for perhaps another decade, is just to give you a sort of the order of magnitude. But again, along the way, there will be some significant disruptions. All right, there's the S&P on a daily basis, so new all-time highs, and we're seeing the same thing at the NASDAQ level. And if we look at the Russell 2000, haven't quite broken out yet, but very close. So the small caps also doing well. So again, let me just make the point, really broadly based rallies are very healthy for the market. This is not just being led by the FANG stocks. As we saw going back to 2007, that market wasn't healthy. It was being led by a very small number of large cap tech stocks. That's not the case now. This is extremely broadly based, which is a very good sign. I just forgot to look at the currencies. So if we look at the US dollar, you can see we had quite a sharp rise the week or so before that, but eased back a little bit. So we'll see where the US dollar goes from here. It's undoubtedly related to inflation data and comments by the Fed, all of which are a bit unpredictable. This is the Australian dollar. So we obviously managed a bit of a rise. We broke support the week before. The fall in the Australian dollar was greater than the rise in the US. Now we've bounced back to retest that breakdown, which again is a very normal technical pattern. And I don't know what the Australian dollar is going to do in the short term, but if you're invested overseas, and particularly in America, and you're invested in high growth stocks, then the movement of currency up or down is really pretty much irrelevant compared to the potential gains that you can make because of the growth of those stocks. So for me, I don't worry about the currency too much. I just try and focus on being in the best stocks, use the cyclical patterns that we see, the strength leading into earnings, take some profit off the table on earnings, and just focus on managing your portfolio rather than worrying about what the currency is going to do. Australian stocks, so 75.5 was where we finished on our dollar. Our index gave back 0.8. There was quite a bit of overseas selling in our market of our major stocks last week. I think we gained 0.8% the week before. We gave it all back, and it was really more about healthcare majors. Healthcare majors had a terrific surge the week before, and they pretty much gave it back. But also energy and banks were where some of the selling was focused. And on small cap set a new all-time high in Australia as well. So let's just take a quick look at that market. There's the ASX 200. It was really, there's the big fluctuations in healthcare. Surged the week before, gave it all back last week. But if we look at small caps, break out to new all-time highs and good volumes behind this move as well. So things looking pretty good for the small cap part of the Australian market. We often see tax loss selling, stocks that have been down in the first half of this year where people might have losses, they've got gains, big gains in other stocks, and they're looking to crystallise those losses to offset some of their gains. So that has probably been occurring over the last few weeks, and a lot of those people have sort of moved out of those stocks. They've sold them off, and other investors have moved in to snap up some bargains. Now, if we look at precious metals, gold was up $17 to $17.82. So key support is just holding. But really, this little bounce was not anything more than just currency effect. From what I can see, there wasn't anything in the way of buying beyond the currency. And so, this is a market that's on very shaky ground. It's reacted very badly to the changes the Fed's talked about. It's not totally logical, but it is what it is. And I think the long term, my expectation is the long term for precious metals is still good, but at the moment, it's weak, and we've just got to recognise that it's weak. And 1690 is still possible for gold. And look, it's GDX just managed to hold itself steady for the week. So we'll check those couple of charts. We'll look first of all at the daily. There's the daily chart on gold. So really didn't do very much at all. The weekly shows we're pretty we're sitting pretty precariously at the moment. So this looks a bit like the Bitcoin chart in a way. This is quite critical support. And silver is is pretty much the same. So not much change in the precious metals market, and GDX reflects that. One of the things to watch, of course, is watch GDX in relation to the price of gold. It'll lead in both directions. So if we are going to see a resurgence in precious metals, you want to start to see GDX start to outperform the gold price. And if we look at, it's not the right one, that's the one I was after. So this is GDX divided by GLD, and normally this would average something more like 0.45 is a decent long-term average. You can see that gold stocks relative to the price of gold are actually quite cheap, down here at 0.21. And really, we've not really done very much. You've got to go back to the middle of 2019, and we're at the same level that we were at in the middle of 2019. And we're also at the same level as we were at in June of 2016. So there's been a lot of fluctuation, but if we are going to see a long-term surge in the precious metals sector, then I would be looking for this ratio to break 0.24 to the upside. So gold stocks start to lead the precious metal would be much healthier. Other commodities, copper was up 425, nickel was up quite strongly to 836. Part of it was currency, part of it is just a return to trend. The base metals had done extremely well earlier in the year. They'd probably got a bit overheated, and so we saw a return to trend. And it doesn't mean that the main trend is all over, it's just a return to the mean. So nothing more than that. Crude oil, West Texas Intermediate still continues to defy the green revolution. People were expecting that because of that, the demand for oil would suddenly disappear. It's not happening. It was never going to happen. I don't play very much in the oil market because it's too geopolitical for me, which makes it unpredictable. I like to play the odds. I like to play where I feel that things are relatively predictable. And certainly the crude oil market is not one of those. But look, it's hard to argue with the trend. We've broken resistance and we just keep rising. Even against, I think I reported last week that the currency was against crude oil, but it went up anyway. So there's still a lot of strength in the crude oil market. So there's spot copper. We managed to turn up, but nickel did even better. That was quite a sharp turn up in nickel. And the outlook, obviously, for both those base metals is pretty good. All right, so bringing it all together, there are some tremendous opportunities, which I keep talking about every week, and they're there if you want to go and find them. But just erring for a minute on the conservative side. So let's not get ahead of ourselves and throw ourselves into the market. Let's look at things on a bit more of a conservative level. And I'm talking in the US now. So there's been this huge debate all year about inflation. Will we get it or will we not get it? To me, it's logic, which doesn't mean that it's going to be right. But logic would dictate that we're going to get wage growth because there is no question there is a shortage of labour in the US economy. There's no argument about that. A lot of businesses are struggling to hire the workers that they want, both skilled and unskilled. So the inevitable outcome from that will be some level of wage growth in America. And at some stage, at the moment, we've got high economic growth on a relative basis, very high economic growth. And so we've got really strong revenue growth. But at some stage, and this might be in 3 months, it might be in 18 months, I'm just talking about at some point in the future, revenues are not going to continue to grow at their current rate. They're going to normalise back to more normal levels. Again, it's just reversion to the mean. It doesn't mean anything bad is going to happen. It just means that the growth we're seeing is going to moderate back to a more normal level. So if you get more, and currently stock prices are being priced on the basis of this very high growth, which at some point will slow. Now, when that happens, if we've got higher wages, then for a lot of companies, there can be a very substantial impact to profits and therefore to share prices. So that is coming at some stage for many stocks. And a lot of the stocks that have done really well in the reopening of economies from COVID, those sort of bounce back stocks, they are going to be impacted. So, I don't see those as stocks that are just going to continue to work their way higher. So the solution for me is that we want to target companies where the growth in revenues and therefore ultimately earnings is so big that rises in expenses don't matter. Yes, their expenses might go up 15, 20, 30%, but their growth is so large that it just doesn't matter. It's the companies that are only growing at 5% that cop a big hike in wages. They're the ones that are going to suffer. So they're the ones you've got to look out for. So it comes back to what I talk about constantly, and that is the importance of growth. That it's all good to go back into value stocks, but if they're value stocks that don't have revenue growth and high probability revenue growth for the future, then the current share price rises we're seeing are just not sustainable. And I get questions from members and others outside of my memberships constantly about wanting to buy stocks and sit on them for 5 years. Well, if you're going to do that, you want to be very, very sure that those stocks are going to have that sort of high probability, high growth that can offset things like significant wage growth. Now, last week in Portfolio Analyst, we had a look at the outlook for nickel and also did some exercise on position sizing for trading. So working to a fixed risk kind of model, which I think members found quite valuable. So that's it for this week. Just let me leave you with these sort of final thoughts. And again, I'm in the position where I get a lot of questions from members. And so I get a sense of what people are thinking. And some people are still waiting for a correction before they get really stuck in to the market. They're just waiting for things to clear. My interpretation of the market at the moment is that we're getting those pullbacks already. We're getting those corrections. They're little rolling rotations. We're not seeing it at the S&P level or the NASDAQ level because that's too broad. But if you look at the sector level and you look at the individual stock level, we're getting them now. We're getting corrections. We're just not seeing it at the index level because this is such a broadly based rally. So these little rolling rotations are doing the job of correcting the excess in the market. So use that to your advantage. So the process is get your stock selection right. Identify stocks that are high growth, high probability. Secondly, identify potential entry zones. Now, none of us know what a good entry point looks like until after it goes down and reverses and starts going up again. But if you know what you're doing with technical analysis, you can have a pretty decent stab at where a likely reversal zone might be off support. The third thing you do then is just wait. And finally, the most important thing is have a large list. If you've only got a tiny list of a few stocks, then it's harder to wait because if a stock pulls back a bit, you want to buy it. And it may not yet be at a good entry point. So have a big list. So if you do all those things, I think you can do extremely well in this sort of environment, as tricky as it is. And, it is a difficult market. So I'll leave it at that, finalise on that point. There's more information on the website. There's my email address for anyone that wants it. And I'll be back with you next week. Cheers.